Welcome back, investors. Jake here. In this video, I'm going to be selling out of a position entirely, and that position would be Capital One. At the time I'm filming this video, all of the indexes are red, and before we talk specifically about Capital One, I want to first broadly talk about the markets, where I define the market as the S&P 500. And this sell-off that we experienced in January is very significant. From the high of 4,793 to the intraday low, the S&P got as low as here on Monday, below 4,250. This was a greater than 10% drop. This was a market correction. And the S&P got below its 200-day moving average for the first time since the COVID crash. And it's not really bouncing back or snapping back as nicely as it did during previous market sell-offs. So once again, before we talk about Capital One, let me just zoom out for you here and show you the technicals on the S&P 500 going back 20 months, because this is incredible. I don't know if the stock market has ever done this or looked like this, but here is the March 2020 COVID crash. The S&P got as low as 2,234. And it's stayed within this channel. This is Congress passing all of the stimulus, increasing the money supply. This is the Fed lowering interest rates, doing quantitative easing, buying up corporate bonds in the junk bond market. These two lines are parallel, and the S&P stayed within this range, briefly got above it here, briefly got below it here. But this trend line going up over 20 months is incredible. If you had just bought call contracts on the S&P 500 in March or April of 2020 for 2 years out, I mean, you'd be vastly wealthy. Hindsight is 2020. I'll be ready for the next pandemic crash, guys. But this channel that we've been in for 20 months is broken. And this is significant from a technical perspective because the market had always been creating higher highs, higher highs, higher highs, higher highs, higher highs, higher highs, and higher lows, higher lows, higher lows. Even this, a higher low, a higher low, a higher low. However, that trend is clearly broken now. We've been outside of this channel for more than a month. I don't think we're going back in, guys, and the level of support, you could argue, for the S&P 500 is here at 4,300. And lines of resistance, lines of support don't really mean much for an index because people don't set buy limit orders and sell limit orders on the entire market. They do that for individual stocks. So for individual stocks, lines of support, lines of resistance are very significant because large funds do set sell limit orders or buy limit orders at nice round numbers. That's just how these guys think. So this line here at 4,300, I don't know if this is a specific, point where large funds will step in and buy to give the market support. So the fear is, amongst all technical traders right now, guys, is that we've stopped this channel for an uptrend. And are we creating a new channel for a downtrend? Is this a peak here? And then is this a lower high? We're going to create a lower high, lower high. This is the new highest low, lower low, potentially lower low. So in the next month, we're going to find out which is it. Is the market potentially reversing and we're going to create lower highs going down, lower lows going down in a clear reversal? Or has the market just entered this range of sideways consolidation where generally there's support here, potentially if we get here, there will be selling. My prediction going forward is that we are in this range of consolidation. The S&P by the end of the year will just finish either up 5% or down 5%. But when technical traders look at this kind of stuff, the fact that the market can't get back to where it was or can't get to all-time new highs, then they're just kind of anticipating that the market's going to go lower. And if you're looking to buy, and from a technical perspective you think it's going lower, you're just going to wait to buy until you create a new lower low. And we got a couple big events coming up in the next 2 months, guys. Next week is the third Friday of the month. I've talked about this on my channel, how the third Friday is the most traded day of every month where options contracts expire. Liquidity in the market just kind of dries up a little bit as large funds have to cover all their positions that they'll be either exercised on or they plan to exercise on other people. So this chart shows you these dips whenever we get to the third Friday of the month. Additionally, there's still this tension with Russia and the Ukraine. Obviously, there will be a temporary sell-off if Russia takes military action. And then the Fed is meeting in March, and you can't 100% predict the future, but I feel like it's a guarantee they are going to raise interest rates. The question is by how much, and in the short term, how will the market react to this news? So currently in my Schwab accounts, year to date, I'm down 16%, only down $53 today. That makes me happy. And I'm trying to build up my cash balance to pivot my account to new positions. So I'm waiting for the next flash crash, panic sale, looking at the technicals, looking at the stochastics, and then I'm going to deploy this cash on positions that I feel like are temporarily oversold. And I've been in Capital One since November of last year when the market basically peaked. I thought it was appropriately valued, and I argued at the time that the technicals supported a new uptrend. So Capital One hit this range of consolidation between about 140 and 170, 175, and the 200-day moving average was about to catch up. That's when I chose to get involved with this stock. However, the technicals now are a nightmare with all four of the moving averages. One, they're reversed, which is not a good sign, but they're all just kind of jumbled together in this range. So I think Capital One is range bound. In general, with the bank stocks, guys, people are bipolar about them, and they say, hey, interest rates are going up. Banks make more money when interest rates going up. However, shouldn't we be selling everything? Isn't everything overvalued? When we look at the technicals on TradingView, I mean, there's, I guess, a line of support here at 140, probably still a strong line of resistance here at 175, but the stock no longer interests me from a technical perspective. I was on the conference call for their Q4 earnings, and they beat by revenue, they beat by earnings per share, didn't help the stock at all that day. And originally, Capital One, I felt like, was decently valued relative to their competitors. And when you evaluate a bank stock, we're currently on macrotrends.net, but when you look at a bank stock, traditionally they use their price to book value. And Capital One's price to book value is 1.08, which is an all-time high for the stock. Not a good thing if sellers are looking to sell off stocks that are overvalued. However, when you look at Capital One's competitors, for example, JP Morgan Chase, I understand this is a much more, more well-known, larger, more premium brand, so investors are willing to pay more. But their price to book value is 1.59, which is 30% higher roughly than Capital One. And when we look at American Express, this doesn't make any sense to me, but American Express's book value is 6.23, five or six times more than Capital One, but for some reason, investors feel like they should be paying this. If you're looking for a stock that might take a tumble soon, based on its price to book value, American Express looks very overvalued. Okay, so let's go back to my account, and I currently have 5 call contracts with a cost basis of $5,700. I could sell calls against them, but I just don't want to be involved with this stock anymore. There are other positions that I want to take that I like better. So I'm currently positive 2%, haven't lost any money, guys. So I'm going to just sell to close to get rid of these contracts. Here's the trade window with Schwab. Once again, 5 contracts, sell to close with a strike of 160. These were gonna expire in June of 2020. This is 3 or 4 months out. So once again, I just don't want to be involved with this position. we're going to review, order, and execute. Back in my account page, and you can see that my cash balance is now up to $31,000. So account value currently $49,000, and I've got this $31,000 to deploy. Now, most of this cash, when I deploy it on the next flash crash market sell-off that I think is coming in the next month or two, I'm just going to be buying to close a lot of these calls that I've opened against long calls that I have. So I've currently sold calls on Apple, Berkshire Hathaway, and Texas Instruments. If the entire market pulls back, I've got to first basically buy back to close these contracts. So I don't really have a full 31,000 that I can dump into new positions because these contracts have negative value that I have to deal with first. Okay. So I know one of the most common questions is Jake, what stocks are you looking at? What stocks do you want to buy? We'll talk about that when I take those positions, but I'll just give you guys a sneak peek in that I think Google is an amazing buy at this moment. If the market pulls back and goes red next week because it's the third Friday of the month, I definitely want to either buy shares or buy call contracts on Google, given that they had a fantastic quarter, and the stock is basically, since their earnings, pulled back to where it was before their earnings. So on earnings, the stock shot up. It was actually up 10 or 11% at market opening, and then it immediately started selling off after earnings. And the reason why is because people are just so eager to take profit. Anybody who was buying down here, as soon as they saw it shoot up here, they thought, great, I just made 15, 20% of my money. I'll get out now and potentially come back to this stock later. But Google's P to E is something ridiculous, 24. I mean, their forward PE has to be close to 20. And once again, we got that stock split coming up in June or July, 20 for 1. So from the technicals, the fundamentals, I just personally, being a YouTuber, Google owns YouTube, I definitely want to get into this stock. The other position we got to deal with, guys, is Facebook. And I've been watching this, waiting for the sellers to exhaust themselves. When you look at the stochastics, the percent K is over the percent D, but we're still in the oversold area. And I'm waiting for this line to get into this sweet spot range, which triggers a lot of different technical indicators out there that this is the time to buy. And I'm just going to tell you what's going to happen is that as soon as this starts trending up, it's going to rebound to its 20-day moving average and then bounce off of it. So there's a very small window because currently the 20-day moving average is at 282, the share price is at 221. That is a huge price range if you're trying to trade options on that. So I'm waiting for the technicals on this to turn. If there's a big sell-off next week, I think that's the moment to pounce and either increase my positions with the same call contracts, basically lowering my cost basis, or I'll just open a debit spread for a short-term trade in order to maximize how much money I can make in basically a 3 or 4 day window. That's how I think I can get out of this negative $6,596 position. If you guys have been watching this account or watching my trades, I haven't sold anything for a loss yet. Since I basically fired this account back up, I only sell when I take a profit. So I am looking for solutions, being the fact that I started this year at $60,000 and I am currently down about $10,000. We're going to come back from this, guys. I'm feeling pretty confident. Okay, guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. If you have any questions or comments, let me know down below. I pretty much make videos daily now, so that video on Google and that video on Facebook potentially next week will be coming. Till the next video, guys, take care.